Good morning, everyone, and welcome so much this morning to our PPP loan forgiveness webinar. We're going to wait just a moment or two to allow those of you to log in, and then we're going to get started. All right, once again, good morning, everyone. I'm Jill Zozula with LSL CPAs, and I want to welcome you today to the PPP Loan Forgiveness, Your Critical and Questions Answered webinar. This is part 2 of the presentation that we did a few weeks back. And once again, we have Dave and Mark here to give you the latest update on everything with forgiveness. So thank you so much for joining us. A few housekeeping items before we get started today. We received quite a few questions in advance, so we want to thank you all for that. Also, we are taking Q&A at the end. Dave and Mark will be answering as many questions as they possibly can, so please make sure to put those questions in the Q&A box. So if you hover your cursor down to the bottom of your screen, you're going to see a Q&A box. Please put your questions there and not in the chat box, but please let us know if you have any questions regarding audio or anything like that in the chat box. And also, you are going to be getting an email later today with a link to this recording. So if for some reason you have to leave early or you want to listen to it again, you'll get that. And I'm also going to put in the chat box a link to the slide deck today and also a link to the forgiveness application. So without further ado, I'm gonna hand it over to Dave Myers and Mark Zimmerman from LSL. Dave, take it away.
All right, good morning. Welcome back, everybody. It's been a couple of weeks and we've got some guidance, and that's the good news. But first, let me introduce myself. I'm Dave Myers. I'm the tax partner at LSL. And Mark, I'll let you introduce yourself.
Good morning, I'm Mark Zimmerman, and I am a tax director at LSL.
All right, let's go over the agenda. We're just going to give you some of what we think are the main takeaways, some of the main items that we think we should focus on, and then we're going to jump into the pool. We're going to go down and start going through some of the calculations, and then at the end we'll have time for Q&A. So as we go through this, if you have a question, go ahead and type that into the Q&A box, and we will do our best to address it at the end. If we don't, it might drag on, and anybody can leave at that time when we get to that point, but we'll try to answer all the questions if we can. Okay, so let's get started. So the first thing is just a general observation, and it's kind of based on, we have to kind of go back with the history of the program. And Congress really wanted to get out money to keep people employed, and they devised a pretty genius program, the Paycheck Protection Program. And the goal was to basically give away money to companies for them to keep their employees employed during the coronavirus pandemic. And then Treasury, went out. We had a Oklahoma land rush type thing to get our loan applications in. The Treasury is saying we're limiting, number one, we're limiting the amount, it's going to run out. So first come, first serve. And also they put in a provision that we're limiting the forgiveness to 75% of the total forgiveness amount had to be 75% payroll cost, which was nowhere in the statute, something Treasury made up, and to try to, because they thought was the funds were going to be scarce. And I think at the time we did a webinar and we told you that if they run out, they're going to reauthorize more. They're just not going to let this go away. And they did that. And in the meantime, Treasury is tightening down all the rules and issuing threats to companies that we're going to throw you in prison, basically, if you took this money and you really didn't need it. If you could go out and get money elsewhere. The attack was first on publicly held companies, and then they expanded that to go after private companies. In our last webinar, we really hit home on that. And that kind of was like the crescendo of the tightening and the chilling of this program. And you see on the second, they still have not, they're at least a week away projected from running out on the second tranche, because it basically had a chilling effect. And so that was like the crescendo. And I think there was a lot of blowback. Somebody, I think we said at the Treasury, had a sitting down with somebody, and then we saw a break in the armor and a turning at that point. And that was when they basically said, if you have a loan under 2 million, then we're going to deem that you, when you certified that you did that in good faith. It's the safe harbor. That was a great thing. And so it's a first turning point. And now we get instructions, the forgiveness form and instructions. We get that coming out. And looking at that, there's a definite sea change in Treasury's approach. It's much more business friendly. I love saying this for a change, but I don't know, Mark, you were telling me a story about, how this is affecting borrowers or businesses too. Do you want to share that real quick?
Sure. About a month ago, an acquaintance of mine was asking me about this, and we were talking about it. And they have a Schedule C, and no employees, so would be a very simple application and a very simple forgiveness calc. And it sounded like okay, he was going to do that the next day, and lo and behold, I talked to him just earlier this week, and he had not done it. But was saying, I really should do this, shouldn't I? I mean, I'm not a bad guy if I do it. Like, of course you're not. You weren't then, but he was reading all the negative press stories, and so I think he's filing for a loan today, which that's good, because this second batch of funds is going to run out in the near future. So if there's anybody listening that hasn't filed the original application, now's the time. But it is Treasury's approach that people that they were almost saying you should only get this loan if you were close to bankruptcy, or that this was the only loan you could get, and that was not Congress's intent at all. Congress wanted everybody that was in business to get this loan and get money in the economy and get people paid. So I'm glad that people are starting to hear that, hey, wait a minute, this is a good thing, let's go do it.
So that's kind of the flavor, and I think it's going to, we're going to get the funds used up quickly, because this is a more friendly approach. And then one more thing besides the form and instructions, and there was meetings on Monday, and Mnuchin, and they had, I think they had representatives from the restaurant industry at the White House. And so right now there seems to be bipartisan support for expanding the forgiveness period from 8 weeks to 12 to 16 weeks is what Congress is proposing. They're trying to get a clean bill through to do that without having to put a bunch of other garbage in it. But I'm not holding my breath on that. And the Trump administration also they're pushing for a 24-month or 24-week period. So you have a range of 12 to 24 potentially that we're going to get the 8-week period expanded. And that's going to make a big difference as we go through. We'll kind of explain some strategies, but you kind of keep that in the back of your mind, because we're going to be telling you everything 8 weeks, 8 weeks. You need to move on the 8 weeks, but there's going to be some issues that come up when we go through this, that it could be 12 to 16 week period. It looks like 16 would be a good guess. It's in between the 12 and the 24, and it's been talked about. So just keep that in mind. But now let's go into the forms and instructions. So incurred and paid treatment, what does that mean? That was one of our biggest questions, and it's the biggest surprise and business interpretation of the rules. We were wondering if you had to incur it and pay it both to get the forgiveness treatment. And this is not a restrictive, this is an inclusive item. And when we get to the next section on payroll costs, I'll explain that a little bit more, but it's basically you're getting cash and accrual treatment combined. Okay, so we'll get to some examples of how that's calculated. It also created an alternative payroll covered period, and so we'll talk about that in a little bit. But basically, you can have your 8-week period can slide and start at a different time than your loan funding date for payroll costs. The definition, we got a definition of FTE. We were thinking it was going to be 30 hours. It's actually 40 hours. And if you have employees, part-time employees, instead of going through and calculating a fractional amount for those employees, you can use 0.5 for all the part-time employees. You're going to have to do some calculating to see if you even want to use that method. You have to use that for all part-time employees. It's not, you can't pick and choose between those. So we got some more definition of FTEs. We have a wage rate safe harbor and a FTE safe harbor. Mark's going to go through those in detail when we get to that point. We had a big question about annualization of compensation. So let's say that during the 8-week period, you're a weekly payroll and you pay bonuses out to your employees to maximize your forgiveness, but you do it in the 8th week. We were concerned that the amount per week would be, I think it was $1,833 versus the 8-week period compensation limit. Remember, you can only deduct up to an annualized compensation amount of $100,000. So for an 8-week period, it's $15,385. We got the better answer on that, which is it's an 8-week period. So you can backload all your bonuses and prepayments and things into the last week and get the maximum cap. And then we had there were some questions, excuse me. There were some questions about if you didn't get if you didn't arrive at 75% of your cost as payroll costs, that it was like a cliff test, that you would get zero forgiveness, and that's not the case. It's exactly how we described and we thought it would be in our last webinar. You're just basically, you take your payroll costs, let's say you have 75,000 in payroll costs, you calculate that for the 8 weeks, you divide that by 0.75 to get 100,000 is your maximum forgiveness amount, meaning you could get non-payroll cost of 25,000. And then one thing, and we'll talk about this as we go through it, the compensation or the payroll cost, that it appears that we partners and sole proprietors, you got your loan amounts and your loan forgiveness amount is based on the 2019 salary divided by, divided by 52 times 8, and you're going to use that for your forgiveness amount. But in this case, it looks like the instructions are requiring payment. So you have to take a draw, you have to take, as a partner, just make sure you take that payment during the forgiveness period. And it appears, contrary to some earlier guidance, that sole proprietors, it was said you could only use your 2019 Schedule C amount divided by 52 times 8, and that's the total amount of that's qualified forgiveness. But it appears that based on the calculation, you can use rent, utilities, and mortgage interest in the forgiveness calculation. So any comments, Mark, on the main takeaways before we jump in?
I think you got it.
Okay, let's jump into the calculation of payroll costs. Okay, so what are payroll costs? That's going to be a combination of cash compensation, which is your traditional payroll, wages, sick pay, vacation pay, bonuses, and non-cash compensation, which are health insurance premiums and retirement plan contributions and state payroll taxes, employer state payroll taxes. And what you get is it's incurred in the covered period, and in the presentation, I'll just refer to the covered period as CP. That starts the date your loan funds, and it goes 8 weeks. Now, again, that might get extended to 12 to 16 weeks, but we don't know. Paid in would encompass, so it's paid and incurred during the covered period. Paid is payroll paid in the covered period. It would also be, so let's say you have a monthly payroll and you fund on April 29th, and then you pay on April 30th. That April 30th payroll was for wages earned in April, but presumably that would qualify towards loan forgiveness. Then if you have your 8-week period would end, let's say in June, I'm not sure of the dates on April 29th, but maybe June 26th or June 27th, something like that. And so you've incurred let's say it's 26 days in June, and your payroll is paid on June 30th. You can also include those 26 days that you incurred payroll in June. So you're going to get basically 3 payrolls into the loan forgiveness amount. Okay, so that's a huge item right there. And so both of those count. And you have, what counts is that the payroll on that last payroll that you're accruing has to be paid on the first pay date after the end of the covered period. So if you have multiple pay dates, you know, one for hourly, one for salary, then I think you could, you know, it's on those particular wages. And as you can see, when we get going, everything's on an employee by employee basis. So both would count. It's a big item. The instructions say no double counting of the same payroll costs. So as long as you don't say, I accrued that and I paid that, I'm going to take both. As long as you're doing, you know, your cutoff is appropriate, then you should be okay. You're not going to be double counting the same payroll costs in the example I gave you, because the payroll you paid on April 30th, that was earned in April. You're not double counting any of the same payroll. Okay. The new alternative payroll covered period, you can shift your 8-week period to coincide. The 8-week period wouldn't start for payroll costs, would not start on the loan funding date. It would start on the date your first pay period after funding starts. And then you measure it on an 8-week period. You can only use this method though if you're a bi-weekly or more frequent, which I presume weekly. There might be some that do daily, I'm not sure, but or twice a week. But anyway, it's usually bi-weekly or weekly. And you can see if it's bi-weekly or weekly, how that would fit within the 8-week period. You could get it so that it coincides, so you're not doing that accrual at the end of the payroll period. So in my monthly payroll example, you could not use this. You would have to do the accrue the last 26 days of the month. So for both methods though, now I'm going to get back to both methods. The calculation is on, like I said, is on an employee by employee basis. And there's different limitations for owners, partners, and sole proprietors. Okay, and again, the maximum cash compensation is $100,000. Remember I said payroll costs are cash and non-cash. So the maximum cash compensation is $100,000 on an annualized basis, and that's for owners and employees also. So the effect of it, of the $100,000 limitation, is that for each employee, the maximum that cash compensation that you're going to be able to put in towards forgiveness, your forgiveness amount is $15,385. So if you're thinking about paying bonuses or, you know, bumping up your payroll during the forgiveness period, that's your amount, and it's on a per employee basis. Owners, and so one negative thing they did here is owner employees. This is how they defined it, owner employees. So is that an S Corp owner that's an employee? Probably. Is that a C Corp owner that's an employee? Maybe. We're not sure on that, but it's definitely partners and sole proprietors, self-employed individuals. Your amount is not just $15,385. You have to go back and say, what was my compensation, my 8-week equivalent? So you go back to your 2019 compensation, what you used to generate your PPP loan, divide that by 52 and multiply by 8. And so my forgiveness amount is going to be the lower of what I actually pay myself during the forgiveness period, or my 8-week equivalent. So if I didn't pay anything to myself from my company or from my partnership, or didn't have anything in 2019, then I'm not going to be able to get anything on my forgiveness period. And then again, we talked about this before, but if you are a partner or a sole proprietor, it appears that you need to cut yourself a check for the $15,385, if that's what you're going to get the forgiveness amount on, or whatever your forgiveness amount that you're anticipating, you need to write yourself a check. So you can't just rely on the fact that you generated that income. It's going to pass through to you anyway. It seems like that's what you're going to need to do. Okay, so we just talked about cash compensation. Now non-cash, that's the health insurance premiums, retirement plans contributions, and your state payroll tax on employee compensation. These are not subject to the $15,385 limit. So now you can start, health insurance, maybe you can't, that's not too flexible, but maybe with contributions to retirement plans, you could do some planning here. It appears that owners can't include non-cash payroll costs in loan forgiveness. I think we're not sure on that, especially for S Corp owners. I think that we need to watch that and see, but we can make a case that S Corp owners would still be able to get health insurance premiums, contribution to retirement plans, and so forth included in the forgiveness amount, but we're not sure. So yes, go ahead, Mark.
I think what we might want to mention here is that the reason we're not sure is that the 11 pages of guidance that came out last Friday, 6 days ago, that guidance seems to imply that we might get it. And it was the earlier guidance from Treasury and the SBA that said we wouldn't get it. So we don't know if it's, it wasn't as clear as we would like in the 11 pages, which is why we're being hesitant, and we're hoping that will be included in the regs that are still, we're still promised on April 26th and haven't arrived yet. So.
Yeah, very good. So, just in general, we received the final, the form's final, and the instructions look final. We had the form and instructions issued before we had the rules and regulations that would drive the forms. I don't think I've ever seen anything like this. So the question is, can we rely on the form and instructions? Well, I think we can. It tips their hand and what direction they're going to go. They're not going to issue the form with instructions, but there is some of these things where we might get some more guidance and refinement from the rules and regulation that will be issued. They were supposed to be issued by April 26th, so we're working on a month here. So keep that in mind as we're going through this, but we feel, so why do this webinar if it's just form and instructions? Well, we think this is going to be the direction of the rules and regulations, but there might be some refinement. So the paid and incurred inclusiveness, this whole, this whole thing about, getting multiple payrolls into the forgiveness period, getting, if I pay for something at one point and it relates to cost incurred before the forgiveness period, the covered period, if it relates to that, it's paid, it appears that would count. And then on the other hand, if I pay a health insurance premium on the first payment after the end of the covered period, then I can accrue a portion of that also. So it's the same paid and incurred inclusiveness on non-cash payroll costs. All right, so That's kind of gives you a definition of what's going to go into payroll costs, which are both member cash and non-cash. And we gave you the main concepts. Now I'm going to turn it over to Mark to talk about these things that we get most questions and the most confusing, and it by far the most complicated part of this whole calculation, requiring multiple steps on different levels, different periods. And so since it's rising to a level above my pay grade, I'm going to turn it over to Mark and have him go through it and try to make some sense of these wage reduction or these forgiveness reduction calculations, and with an eye on trying to help you navigate that. Rather than just get a total understanding of the calculation, we want to help you take actions to minimize or eliminate some of these reductions. So thanks, Mark.
Okay. Well, let's take a moment and just set the stage as to where we are. In the last webinar, we talked about the fact that once you've calculated payroll costs, you then would have to apply two limitations, and then there would be a safe harbor to get out of those limitations. Well, the good news is that that safe harbor is really two different safe harbors. So for the FTE reduction limitation, we have a safe harbor, and for the wage reduction limitation, we have a safe harbor. And in addition to that, on the form itself, there are a couple of, I'm going to call them shortcuts. Some, you may see articles where somebody says that SBA created another safe harbor. No, they didn't really. All they did was give you another way of asking a question, does this limitation apply to me at all? And if you meet those, you can just check the box and move on. And so that's where we are. And the other piece, well, I guess we'll talk about that later. The SBA decided to apply the FTE limitation first, and later on we'll show you why that's better for every taxpayer, or every borrower. So that's the good thing. So the one bit of bad news that we have in here is that they chose to use 40 hours for the FTE instead of 30 that was used in the ACA Act or the Affordable Care Act or for other tests on employee benefits. And so why is that a bad thing? Well, it's a bad thing if you had basically a workforce that worked 40 hours in 2019 and the first part of this year, and maybe rather than lay off a group of people, maybe you cut everybody back to 30 hours. Well, that's going to present a problem unless you meet a safe harbor or something else. But they did define the calculation in a good way, in that nobody can count for more than a single FTE. So if you have a person that works 10 hours overtime, they're not 1 1/4 FTE. They are only 1. And that's really a big deal. So now what do you do with the people that are less than 40 hours? You can just simply divide their hours by the 40 and get a fraction, and it's rounded to a 1/10. That works. Or you can use a simplified method where everybody who's under 40 is just counted as a half. So if you do have a bunch of people that are working at, say, 30 or 35 hours, you're going to want to use that simplified method because it will lower the number, but you might not, because it can get complicated between the look back period and the covered period, and which one does it lower more. So we think it's just going to be, it's a simple enough calculation, and so we think we're going to do it both ways for all three periods. So let's go to the next slide, please. And if you recall from the last time, to calculate this FTE reduction, if you're actually subject to the limitation, you have to calculate it for the 8-week covered period and for those 2 look-back periods. But to see if you qualify for the safe harbor, you have to calculate it for the period that includes February 15th, the pay period that includes February 15th. You have to calculate it at a point in time, which is June 30th, and you might have to calculate it for the whole period February 15th to April 26th. And those are mights. So it sounds like an awful lot of work, and it would be. So how can we get out of that? I think that's the next slide. Okay, so if you know that you had a reduction in FTEs, since COVID started being a problem, right? And specifically February 15th to April 26th, you have the option of restoring your FTE count. These are not specific individuals. This is your company as a whole on June 30th. If you do that, then all you need to do is calculate FTEs for the 1 pay period, including February 15th, and the pay period, and the date, June 30th. That's it. That's not so bad. If you don't qualify for that safe harbor, then you have to do the 3 periods that I was talking about before. Now, this sounds like a lot of work. It is a lot of work, but it's also much better and much clearer than what we knew at the last webinar. Because at the last webinar, we weren't sure whether, how you had to do this employee by employee, for the company, all of that. And so there's much more clarity that we just get to do that. So this answers some of the questions about who do we have to replace, who do we have to rehire, and all of that. We'll get to some more of that in a moment. So, okay. This slide is meant to point out just how much work is involved. Let's say we are calculating FTEs for the look back period January 1 through February 29th. It's entirely possible that you've got a payroll pay date in March, particularly for hourly employees, that would have to be included in that. For a salary employee, if you paid them on March 29th through March 29th, then that's all you have to do. But even though you are looking at this by pay period, you still have to do each individual calculation for the regular method and the simplified method on an employee by employee basis. And then based on the number of pay periods, you have to add those all up, divide by the number of pay periods to get an average. And that's what's going to go on the form, or pardon me, the worksheet table, either 1 or 2, that is attached to this forgiveness application. And if you happen to pay month or weekly, I just want to point out that you might be doing this for 21 payroll periods for one of the look back periods. So That's the 2019 look back. Okay. One of the first indications that we saw that Treasury and the SBA were starting to adopt a more business-friendly approach is when they had a fact about, it was fact 40, I don't remember the date, but the question was, what do we do with an employee who we laid off and they're collecting unemployment, and for whatever reason, they don't want to come back to work? Well, that employee will not count against you. You get to treat them as an exception, and that doesn't enter into the calculation, or actually you have to do the calculation and then you have to back it out. So it doesn't save a lot of time, but at least it's a better result. Well, in the instructions that we got last Friday, not only were those employees excluded, but you're also able to exclude somebody that was fired for cause, who quit voluntarily, or who asked you for a reduced work schedule because they're, for whatever reason, they're caring for kids at home. So those are all very business-friendly ideas and may help, improve the amount of loan forgiveness that you get. The replacement employees, you don't need to go back. The replacement employee is the idea that let's say you laid somebody off and they were a dishwasher, but the person you hired back was, I'm sorry, better example. The person you laid off was a busboy, but the person you replaced them with was, let's call them a junior waiter. So yes, they bus tables, but in certain circumstances, they also serve tables. Is that really a replacement, or is that an improvement in your staff? And so there are going to be lots of tricks and a lot of thought is going to have to go into analyzing, is somebody a replacement employee, or is this a new hire? If it's a new hire, it's adding to your FTEs. If it's a replacement, all it is replacing the FTEs that you lost. Okay, so now we're going to switch from the FTEs to the wage reduction. Now, recall the wage reduction can be either for an hourly person, it could be a reduction in either hours or pay rate. For salary person, obviously, is only a reduction in salary. These types of exceptions that we were just talking about for the FTE reduction, we think they should apply to the wage reductions as well. And the instructions don't specifically say that, but if we go back to this FAQ 40, it talks about these types of people not impacting the limitation calculation at all. So we think it's just an oversight, and that if you take somebody who voluntarily quit, or was fired for cause, out of the wage rate limit, wage reduction limitation, we don't think there's going to be any pushback on that at all. It's certainly the way we'll be doing the calculation. And recall that the wage reduction limitation only applies to employees that are paid at less than $100,000 a year. But this can be broader than you might think. It is now clear that if somebody was paid $50,000 a year, but received a $10,000 bonus in December, that one pay period where they got the bonus is clearly going to throw them over the $100,000 rate. And so even though they're only making $60,000 for the year, they are exempted from the wage reduction limitation. So that's a good thing for business. Fewer people that you have to do the calculation for, and so lower possible limitations. And if you look at the instructions, which you all got a link for, calculating this wage reduction limitation and its related safe harbor is literally a 13-step process. That's what the instructions and the form says. However, next slide, please. Let's keep it simple. You can really, I mean, we really only have to think about this in a simplified manner. If for every employee, like I said, employee by employee basis, if you pay them during the covered period an annualized rate, meaning a per week or per pay period amount that is 75% of what you paid them in the first quarter, meaning you didn't cut their hourly rate by more than 25%, or you didn't cut their hours by more than 25%, or some combination of the two, then they don't count against you. And even if you did, if you restore whatever salary or pay rate reductions that were made, if you restore that by June 30th, then you meet the safe harbor and it's done. So hopefully this is a thought exercise rather than a massive calculation exercise, but it may turn out to be that depending on your circumstances. And can we go back 1 second? One more thing we want to mention is, notice this June 30 test is a point in time. So it's only testing the pay rate. It's not testing the number of hours. Now, for the FTE safe harbor, it's still the same June 30 point in time. And one of the questions that we still have is, so how do you calculate that for how much somebody's working for that period? I mean, we just say on June 30th, they worked an 8-hour day. Our intention was starting June 30th, they're working an 8-hour day. We don't know, but it seems like the way the pendulum's swinging here, it's all towards simplification. So it's probably just going to be some sort of that single day test, or some sort of, yes, we've hired them back full time. Question, just a check the box, yes or no. Okay, I think.
Yeah, this reduction, it's not an hour that you have to bring them back to full-time hour. It's that the pay rate per hour. And so if you had somebody making $20 an hour and you said, I have to reduce you down to $12 an hour, if you restore that by June 30th, and we don't know if that's, you just get a letter to them saying you're restored to $20 an hour, if that's it. It's a rate, not an hourly thing. So just a clarification.
Right, so this one's an easier safe harbor. The wage reduction safe harbor is at least more clear. I don't know if it's easier, but it's more clear than the FTE safe harbor. Okay, so let's now talk about non-payroll costs. And there's there is definitely a whole lot of good news here as well. As you know, non-payroll costs include rent, utilities, and mortgage interest. And again, it's the paid and incurred concept, which is really paid or incurred, applies. And so if you're, rent's normally paid in advance, but if you're delinquent and you pick something up during the covered period, well, that's going to count. It will certainly count. And even though we were expecting explicit prohibition on this, it appears that you can prepay rent or prepay utilities. It is because you're not deducting the incurred part on that's paid by the next regular bill. You're instead literally paying it. And since it seems to be you get to count rent that is either paid or incurred, it seems to work. So there's some wiggle room there. We do need to mention that there is an explicit prohibition of prepaying interest. So you can't prepay the mortgage interest, but it does look like if you have an equipment lease and you want to prepay a couple of months of that to bring it in, because your non-payroll costs are less than a third of your payroll costs, and so you have room to do that in the forgiveness period, it looks like you can. Utilities we still don't have any great explanation of that, other than for all three of these, rent, utilities, and mortgage interest, the documents that are required, you are going to have to provide some sort of document that says all of these were in place before February 15th. So the loan has to be in place, the rent or the lease, or has to be in place, and as do the utility services. Oh, that's just where we went. And again, it makes sense to give you the reminder that the non-payroll costs can only be 25% of the forgiveness amount. Similarly, you need to recall that it's not just the 75% payroll requirement isn't just for the 8-week forgiveness period, but it's also for the entire loan amount. So eventually, during the 2-year term of the loan, you need to use at least 75% of it for payroll. But we're going to talk about that a little bit later too, because there seems to be a move afoot to relax that requirement. I have no idea whether we'll get any action on it, but we'll come back around to that.
So just one note, Mark, on the rentals. We were wondering about self-rentals, where the business owner that owns the real estate leases it to the business, whether there be any prohibition, and there's nothing in the instructions. We'll have to wait for the rules still, but right now there doesn't appear to be any prohibition.
And so our advice on that would be, because of the must be in place February 15th requirement, you probably can't play any games with that in terms of the rate, meaning you can't increase the rent. On the other hand, you might be able to get away with paying a month early. So again, we're only talking, this is only in that 25% portion of the loan forgiveness. So hopefully it won't take too much work to fill that up.
Okay, so we're on the home stretch, I think. Putting it all together. So in the application and instructions, it starts. There's a lead sheet, and then we've gone down into the tables and worksheets to get all the payroll costs, to get the limitations, to accumulate all those, and then it comes up to the top. And the first thing that we noticed just from the general flow of the application is that the pay rate reduction comes first, and then the FTE reduction comes second. And why that's important is that you're multiplying. So let's say your FTE reduction is going to be a fraction, right? So let's say it's 90%, and then you have 10,000 of pay rate reduction. So you're reducing it pay rate down, 10,000, and then your FTE reduction is going to be a percentage of the lower amount. The way it reads in the act is the opposite. So they're giving a break to all business. It's just a mathematic calculation. So that was one of the first things at that level we see. Potential forgiveness. How do you calculate that on the form? It's pretty simple. So they ask you to take, it's the lesser amount of the PPP loan that you got, the total payroll cost and non-payroll costs together, or payroll cost divided by 0.75. So there's your limitation. So if your payroll costs are 90% of the forgiveness amount and non-payroll costs are 10%, then the middle one will be what you're going to be using. But if your payroll costs are 75% of the total, then you'll be using the third one. And in no case can you get forgiveness more than your PPP loan amount. Now, does this mean that, what about the interest that's accruing on the 1% interest that's accruing on the loan? And the form doesn't explicitly or say that you're going to get forgiveness on that or you're not going to get forgiveness. It indicates that the principal, because there's really no place on the form that says put the principal and the accrued interest in. But all the interim rules and guidance that have been issued say it does include the related amount of accrued interest. So we think that just because the form and the form doesn't say so doesn't mean it's not so. And what we think is that you're going to go and say, I have $100,000 of my $150,000 loan gets forgiven, then the bank would forgive the related accrued interest on that. That's our feeling, but there's a conflict there. We'll need to wait. Okay, so documentation that will be required per the instructions. For cash payroll, you're going to need bank statements, your third-party payroll provider reports, Form 941 reports. Again, we talked about this before in our last webinar that you're most likely going to need to have filed your second quarter payroll tax return and your state payroll tax returns. Those are going to be required, so you can include those in your documentation. For non-cash payroll costs, it's payments. Remember, those are health insurance, retirement plan contributions, payment receipts, canceled checks, and account statements. You're going to need to have all those for anything that spans the covered period. Non-payroll costs, mortgage interest, you need to get a copy of the lender amortization schedule, canceled checks, lender statements for the covered period, and again for the February 2020 period, because they want to see that your mortgage obligation existed as of February 15th. Rent and lease payments, you need a copy of your current lease agreement, canceled checks, lesser statements from the covered period and February 2020. And then business utility payments, copy of invoices from February 2020, again, to show that those services were in place at that time. And then those paid during the covered period, canceled checks or account statements. And then you also, and this is not underneath non-payroll costs, but it's just documentation, you have to show how the FTE calculations were made. And so you're going to need payroll tax returns from any of those periods that you're using. So Mark, I think, said there was five periods and one date. You might have to have payroll records that encompass those dates. So another reason to try to reach the safe harbors and not do the FTE calculation if you can, but it's a lot of documentation. I hope you get the flavor that this is a massive undertaking to do this calculation and to get all the documents together. So before we go to Q&A, I just want to kind of summarize a little bit. I know everybody wants to get a spreadsheet that does all these calculations for them. We have one going, but we just think that there's so many pitfalls, and I hate doing a webinar and saying now use our services. We're really trying to educate, but I think in this case you would be wise to employ an accountant or somebody to help you with this, and this has been described as at least a complicated tax return. So if you enjoy doing your own tax return, then we can help you with it and get you some ideas. Between now and the end of the forgiveness period, you can call us, we can go through trying to help you estimate what your forgiveness would be. But in terms of getting this documentation together, filling out the form correctly, it's like a very, very complicated tax return. And you don't want to be leaving any money on the table. And the reason why is that the amount, if you leave any money, that's a dollar for dollar amount that you're leaving on the table in terms of forgiveness. And another thing, we're hearing from banks. So think about the banks. The banks have 60 days from the date of your application for forgiveness to process everything. And how are they going to check that FTE calculation on June 30th, whether you made the pay rates and then if they have to do 5 or 6 different periods, plus all the documentation. So banks are outsourcing, they're using CPAs, accountants, auditors they're going to have an army of people to try to process this. So my advice is don't go on your own. We're here to help. And Mark, any final comments before we start diving into the Q&A?
Well, sure, a couple. To expand on that idea, really, we're not, you can't file for forgiveness until late July or mid-July. The records that you're going to need to use to do that calculation are going to be the same today as then, and there's good reason that you might want to consider delaying filing for forgiveness, because especially since we believe the accrued interest is also on the forgiven amount is going to be forgiven. why not wait? And especially if the 8 weeks might become 12, and who knows when that's going to happen? Might happen after the 12 weeks has passed, rather than before. Similarly, once you get your forgiveness, you're no longer allowed to defer the employer FICA any longer, and so that runs out in December. So there's some argument that when in September, October, when your 6-month deferral runs out, you might want to ask for another 4, because the optimal time to actually file for forgiveness may turn out to be December or January. That meet with your
you
agree?
The 6.2%, that's the employer portion of the FICA, and right now you should be deferring that, and it's going to be paid over basically 2.5 years. The first payment is going to be due the end of 2021, and the other half of it is going to be due at the end of 2022. But you have to stop the deferral of that payment as soon as you receive loan forgiveness. So that's what we're saying there. You're getting the float of an interest-free loan on that over 2 years versus a 1% interest rate that you're accumulating, number one, and doesn't sound like a bad trade-off to me. And then on top of it, when we talked about earlier, that 1% could be on the forgiven amount, could be for the accrued interest could be forgiven too. And if we get an expansion of the 8-week period, what that will mean is more payroll costs can be brought in, and we're at an inherent disadvantage because we did everything on a 2.5-month basis on our loan amount and an 8-week. But if we get to 12 weeks, then we're getting close to the 2.5 months. So we could get close to full forgiveness, especially if we go to 16 weeks and you start bringing people back. And if you get full forgiveness and forgiveness of the interest, it's not just a play between a 1% interest accruing, it's a play between 0% cost of money and deferring more money. So it's something to consider as you're going through. So I think we can go to Q&A right now.
I have one more comment. Okay. I'd like to make, sure, if you don't mind. Dave and I expect that most of the Q&A questions are going to be one of two things. They're going to be, how do we do a calculation, or how do we maximize our loan forgiveness? And on that topic, we need to go back to the paid and incurred for just a moment. If you're talking about somebody who is making over 100, you're going to use the 15,385. That's what your limit is. But if you have somebody under that amount, we need to think, how do these payroll periods work? It's not going to be just 8 weeks, because if you have the right set of pay dates, you might get 9 weeks or 10 weeks or even 11 weeks, depending on what day when your payroll was versus what day you funded. And so that raises, so that's only going to matter for the people that are under 100, but we might actually have larger numbers to start with than we think we do. The other thing is, that idea points out, why in the world would you want to elect the alternate covered period? Because if you do, you guarantee that you only get exactly 8 weeks for all those hourly employees. So I even though it's administratively convenient, I think it's probably a bad idea, and that you probably just want to stick with whatever hand you were dealt between your pay dates and your funding date.
Okay, so excellent. Let's go through some of the questions that we're going to go through. We had some submitted beforehand.
You're gonna start with those?
And one in general is, you know, accounting for these costs and setting up separate GL accounts, like a GL account or coding for forgivable costs. And I think that my advice is account for everything how you're doing it now, and then when you get to the end, we can accumulate those things. You know, it's just going to be payroll reports. Like the documentation that's on the slides is really what's going to drive, you know, what you're going to print out. I don't think there's any particular reason to set up separate GL coding accounts. And then question is about some clarification on what's the look back period. And we brushed on that briefly. There's 2 look back periods. This is relating to the FTE reduction calculation. One is February 5th, no, I'm going to get this right. January 1st through February 29th of 2020, and then February 15th of 2019 through June 30th of 2019. You're only going to go to those look back periods if you're failing the safe harbors, and you know when you do that, then you go back to those look back periods, and then you do your FTE calculation based on, you take whatever one works better for you on that.
And if you have a seasonal business, you can pretty much select a 12-week look back period in 2019, but that's beyond the scope of this discussion. If you really have a seasonal business, that would matter. So,
okay. Next is another FTE question. Like I said, this is the most confusing and difficult part, so we're going to get a lot of questions. I hopefully answered it, but how does the FTE work? I only have one part-time person, and how does FTE affect my payroll loan forgiveness? Hopefully we answered that, but I don't know if you wanted to comment on this.
I would say what you want to do is you want to be sure that that person is working at least as many hours during during the covered period, during the 8-week period, as they did in the first 2 months of the year. That would be the simplest.
Okay, now we're getting into some paid and incurred type questions. Loan received Monday 4/20, pay period begins Monday 4/20, and hourly employees are paid weekly 1 week in arrears. Salary people are paid bi-weekly with no delay, and April 24th is bi-weekly payroll covering 2 weeks of salary and 1 week of hourly. So how do you maximize the claim, or maximize the forgiveness? And it seems we can conceivably collect more than 8 weeks of, or pay more than 8 weeks of payroll. Exactly what Mark just said,
Yep.
And what we've been saying. It's going to happen. So if you pay it, it doesn't matter if it was incurred before the 8-week period, as long as you pay it. On the other side of it, if you incur it, you can pay it by the first pay date after you incur it. So, and it brings up a complication I mentioned earlier a little bit about you might have 2 pay dates. And so the rules, or the instructions, I should say that it's by the first pay date after the end of the covered period. And And if you have a pay date for salary and a pay date for hourly, then I would think it would be both of those two pay dates you can include. I mean, it has the flavor of being on an employee by employee basis. So if you have two different, it doesn't have to be just one or the other. Okay.
And I think that even extends for salesmen. Some people have semi-monthly salary payments or payroll, and then they have once a month that they pay the commissions from the prior month. And I think all of that would work as well. That as long as you're not doing something out of the ordinary, if you're just paying it when you're supposed to pay it, and like you always pay it, then that's going to be fine.
Okay, health insurance premiums. We were late paying a premium. We could conceivably pay 3 months of health insurance premiums. The March late payment, April invoice, and May invoice. Are we allowed to claim all three? And the answer is yes, apparently. Okay, good news. I told you, it's very good news. Okay, the next, I'm gonna let Mark answer these, but it's basically has to do with terminating employees that during, I believe it's during the covered period, and then you're replacing them during the covered period. So how does that affect the forgiveness status?
Well, two points. As far as accumulating the payroll costs during the covered period, obviously the sooner you replace them, the more money you're going to have paid in wages during the 8 weeks, and therefore the higher your forgiveness. If you're literally terminating them for cause, then they fit into that exception, and they shouldn't count against you on either the FTE or the wage reduction limitation calcs. Okay, so I think, just like anytime you terminate somebody, the documentation is going to be key, and I think that doing what's right for the business, absent the loan, is still going to be the best thing when you consider the loan. So if it's time to fire somebody, you need to do it. It's not fun, but I get it. So
it has to do with people that are idle, and you're retaining them, but do you still need to pay them to get the forgiveness amount? It's the whole concept of paying them to do nothing. So what do you say, Mark, on that?
Well, on this one, again, this new exception that we got for the FTE, and like I said, that we think should apply to the wages as well. I think that's a very big pro-borrower rule, because it seems like you're describing a voluntary request to reduce work hours. And in that case, it should not count against you. And we think that's what the application in fact says. Well, or at least the application and FAQ 40 say. So we think that's still a good rule. So I say you have to do what you would normally do to run your business, and just document that that's what you did. Because when you get down to July or August or maybe November, deciding how to do the loan application or the forgiveness application, you're going to need some notes about, hey, these days off were voluntary. They were not furloughed, and because that'll make a difference. Yeah.
Okay. So, and remember though that you can treat it or make it work, like Mark says, so you don't get an FTE reduction. So you might end up getting 100% of potential loan forgiveness because of that. But if you're not paying them, that total amount is not going to go into payroll costs. So it won't be eligible for forgiveness. So it's a consideration still. You know, how does it affect my forgiveness amount? Well, if you're paying them nothing, then nothing will go into your forgiveness amount. So,
But hopefully the work is being assigned to somebody else who is getting paid.
Yeah.
At least that's how I'm reading the question. But
yeah.
Obviously the first step is you need to pay people during the 8-week period. You know, it may get down that we get some grace, you know, and that gets expanded, but we can't say do that now. You know, the advice still has to be pay your people as much as you can during the 8-week period. That's step one.
Are cell phones considered a utility? And the answer, I would say yes. Telephones, and I would expand that. I think there's some elasticity, how's that, for the definition of utilities, because there's also internet as a utility expense. And how about systems for communicating on the internet and all that? Now you have to have that service in place or the policy in place by February 15th. But as long as you had that, the fact that you're paying employees to work from home and paying them a internet access commission or payment, you know, reimbursing their expense, I think you could expand that. So there's a lot of expansion capabilities. And transportation is a utility also. And we don't know exactly what that entails, but presumably you're paying auto allowance or gas for employees or something like that. That may be a utility. Okay. Remember, everything is capped. You can't stuff a bunch of stuff in there and get a bigger loan forgiveness because it's capped at 20 as part of the non-payroll cost, 25%. Next one's a good one. Can we give bonuses with PPP? Can we give bonuses to employees to qualify for forgiveness? I think there was a lot of misinformation that went out that said, no, you can't do that. And at our last webinar, we said, we think you can. And so far, so good. There's no prohibition. In fact, remember what I said earlier, the only issue is we need to cap that. It has to be done so that you can't, you know, pay a bunch of bonuses in the period and get above $15,385 per employee. But as long as you're within that, pay them a COVID retention bonus or pay them a shift bonus, you know, something where they're doing things above and beyond. It's not only allowable, it's a great way of maximizing loan forgiveness and in creating employee morale, increasing employee morale, and rewarding your valuable resource, your employees.
In our last webinar, we suggested that if you were going to pay those bonuses, that the best practice would be to spread them out over as many pay periods as possible. And we still think that's the best idea. It probably isn't required, but that's kind of one of the little safety, you know, why not take the step if you can? You know, because it may turn out that when they finally get around to publishing the rule, they are going to do the 100%, pardon me, the $100,000 test on a pay period by pay period basis. There's no indication, and we're really hopeful that we don't have to. But you know, whether you pay somebody $400 times on 8 weekly pays, or you pay them $3,200, it's the same dollars in their pocket. it's probably not that much more work for your payroll person to do it a little bit at a time. And you've already got the cash, so why delay it to the end? Why not dribble it out since you've already got it?
On the other hand, it appears that it looks pretty good that you could backload it in the 8-week period and be okay. We're just saying we don't have the final rules, and we're interpreting the instructions, and so to be safe, you might want to do that. That's all. The next one is saying if we can't our non-payroll costs, we're not going to be able to get up to 25% of the total. We're labor intensive, or we're not going to get non-payroll costs. And can we provide more payroll to get there? And the answer is definitely yes. So the 25% is just the limit on non-payroll costs, but you can push as much payroll into that 8 weeks as possible and go for full forgiveness. And we were thinking that if they did it on a pure accrual basis, that you would never be able to get to full forgiveness, because remember that the payroll loan was based, or the loan was based on 2.5 months worth of your 2019 payroll cost, and then you're only able to use 8 weeks. So now with the paid and incurred, you might be able to get 9 or 10 weeks of payroll into the 8-week period, or maybe more. And as long as you're under the $15,385 cap per employee, then you might be able to use payroll to get full forgiveness. There's a possibility. You're going to have to do some work to get it, but it's possible.
And remember that I think we said this earlier when we were first going through this, but if you want to give a raise or a bonus to an employee, that's totally permissible. And if that raise or bonus stays under 100,000 annualized, it's completely forgivable. If you have an owner employee or an owner, you cannot give raises or bonuses to them. It won't make any difference. So, I mean, yes, you can pay them, but it just won't make any difference whatsoever.
Okay, so you go through your 8-week period, which might turn into 12 weeks or 16, but let's say you go through an 8-week period and things have not changed. So you retain all your employees. Now you're faced with the choice of going out of business or laying off your employees. Can you lay the employees off after the 8 weeks and avoid how will it affect the forgiveness? And it won't, except one caveat here, and that is, remember the June 30th magic date for the pay rate and the FTE headcount restoration. So your 8-week period is probably, maybe not, but most likely going to end before the June 30th period. So you need to, I think you would want to retain your employees through June 30th to avoid to qualify for the safe harbor element of those two reductions and avoid all the calculations and throwing you into that thing. So that would be the caveat is, yeah, you can lay off your employees after the 8-week period, but you might want to wait till June 30th. And hopefully you won't have to lay them off, because if we're in that situation, number one, we might get the 12-week, might get the expansion, and number two, we might get a round 2. And there's talk in Congress that's forthcoming if goes on, this would be, they already have a vehicle set up. They pulled teeth to get the rules and what they have, and the system's set, ready to go. The bank's lined up. So it'd be very easy to do round two of these loans. Okay. Further explain the accrued versus cash, and I think we kind of hammered that pretty well. Should I pay the last payroll of the 8 weeks early to make sure it qualifies with cash? And we answer that is you don't have to. You can qualify those days within the payroll or the covered period by making the cash payment after the end of the covered period. And then those would still qualify. Can I give retention bonuses? Yep, bonuses are good. We keep saying that. Just watch the limitation on the $15,385 per employee, but it's an excellent way of maximizing your loan forgiveness. Oh, I have some delinquent IRS payroll tax debt from last year. Does that qualify for PPP? For the forgiveness answer is no. It's only state employer taxes, which I think are just state unemployment and the ETT tax, and I think that's it on state. SDI is an employee responsibility, so it's just unemployment and ETT that would qualify. Okay, if I give a raise to key managers during the 8-week period and take it away following the 8 weeks, will this be considered appropriate? I think what you're saying is I'm going to give them a COVID bonus. It's not really a raise, and again, as long as you're not running afoul of the $15,385, if you have managers, you know, maybe they're going to be making more than $100,000 annual salary. You know, it just depends. You know, it's not going to help you if they're over 100,000. If they're under, then you could get increase your forgiveness amount by giving them a raise. I would call it a COVID bonus payment during this period, and then you can reduce it back down. Yeah. If we prepaid rent for the period, including 8 weeks PPP deduction time frame, can we still deduct? Does that qualify for forgiveness? Does prepaid rent? So is that talking about? So you're in June, and your forgiveness period ends June 25th, and you go ahead and pay your July 1st payment in June. Is that what their question is, Mark?
I don't think so. I think they're asking, let's say our 8-week period starts May 1st, but we paid May rent April 25th, and I think you lose on that because I think that in order to get the rent, you have to pay it. Well, you are incurring it. Yeah, I would be worried about that. If you prepaid the rent before the covered period, the obvious thing to do is prepay the rent before the end of the covered period, and then you'll get it that way. So yeah. That's what I would do. Is the amount of rent that you need to include, pay it at the end, and get it included in the covered period.
Yeah, it seems like you paid it and then you incurred it. It would be another expansion of the paid and incurred to include it, although you are paying it within the normal time. But I think the way it's written, you wouldn't be able to do it.
Right, because the way the sentence and the instructions are written, if you're going to include in the forgiveness amount something that was incurred, implicit in it is that it's paid before the next regular billing date, but it's paid after the covered period. So you're talking about, if you're talking about having paid rent before the covered period, I think you're out of luck. But for that same amount, you could prepay it again.
Yeah. And the next question is prepaying this is the flip side of it. Can we prepay the rent for June or for July in June? And I would think yes. I think that's what the instructions imply, and it looks like you can prepay those. Can you prepay? The other question is salaries, and I would say we don't see where that's prohibited. Again, you're up against the $15,385 per person, but if you're within that and you prepay some, it doesn't look like it's prohibited, but again, we're going to caution and say we might get some rules that would prevent something like that. But right now, it looks like you could.
Yeah, and one thing to consider is, who are you going to prepay? Because if these are employees that you know aren't going to leave you, then you're probably okay. But California is going to, in most cases, once you've paid an employee a wage, you're not getting it back. I mean, there are rare exceptions, but yeah. If
prepay wisely.
Yeah, so if you prepay a month, you pay everybody a month early, and a couple of people decide that's the time to give notice, not much you can do about it.
Okay. Next question is leases. So rent, what qualifies? Do buildings, equipment, vehicles? Yes, 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 because it's rents or leases on real or personal property. So your equipment and vehicles are personal property that would qualify. If I file my taxes, with most of the income coming from my sole proprietorship. And so I think they applied for the loan, they got a $14,000 loan, and now they're going to calculate the forgiveness amount. And let's say that if you take the 14,000, and I think
the math is about 10,000.
It comes out to about 10,000 of forgiveness, not including any rent or utilities or anything like that. So this is just a sole proprietor, one person, and we're going to assume no overhead. Just that's the calculation. So let's say it's $10,000 eligible loan forgiveness. We would recommend they just deposit everything. They don't have a separate checking account. Everything, all their commissions come into a personal checking account. We would recommend, well, first of all, we'd recommend that you set up a business checking account and do it separately, but you don't. So take we would say you need to pay that. So we would, just to be safe, we would say put it into another, like a savings account or brokerage account, pay it out, and then you could always put it back in the business, but you need to show, you're going to have to show proof of payment of that when you file your documentation. So a canceled check on that. Okay. Another payroll question. Do I have to use any special codes and the answer, in accounting for it? I would say no. Again, it's going to be just gathering the payroll for the period and then doing the calculations on that. I don't think there's anything you can do in your coding or your GL accounts that will help you. Part-time employees can only work part-time. So for purposes, just the total wage you pay to the part-time is just going to be the amount eligible for forgiveness?
I think the question is, how does that affect the limitations and all of that? And the answer is, if she's working the same schedule in January as she is now, then there's no effect. It's just, that's perfect. You know, now if she worked more hours in the past than she is now, well, by the way the question's worded, it sounds like that's voluntary, that's her request, in which case we think the exception is going to apply. So I think you're good either way. You know, the whole concept here with these limitations is they're trying to make sure people are being paid now what they were paid before, and if that's happening, you're good. So the next question is about, are you limited to one location for rent? And you certainly aren't. If you have a main office and job sites, the job site rentals count.
Okay. Is there a way you could pay your employees in full while they're not performing services? You could pay them to do nothing, first of all, because you're not allowed to open yet, and then get the loan forgiven, even if you have to lay them off at the end of the 8-week period. So again, you can pay your employees to do nothing. We would suggest that you find ways of training, introducing new technologies, having them do something besides nothing, but you can pay your employees to do nothing. And then at the end of the 8-week period, then remember the June 30th caveat on that, you could lay them off and get the forgiveness in the period. Yes.
And the other point to bring up here is, if the employee don't want to come back, then they don't count against you. So the employees that you are paying will get full forgiveness. And yeah.
Okay, a good question. Next one. We are a C Corp, and on the application it says you exclude owner-employee payroll. So you wouldn't exclude, it's for purposes, I think the exclusion was for purpose of the test. What was that, Mark?
It's just a different line. You put the employees that are under 100 on table 1. You put the employees that are over 100,000 a year on table 2, and you put owners on a separate
line 9.
Paper.
I think it's line 9 of the form. Yeah,
that sounds right. So yes, they are included. They're just not subject to the limitations. So it's kind of a trade-off. The owner-employee, you can't claim anything more than you paid them last year. On the other hand, if you paid them less, that's just the number that you use, but you don't also get a penalty associated with it. So
the salaries count, and the question that maybe is the non-cash payroll costs, because it says that those don't qualify for an owner employee, and we think that for a C Corp or an S Corp, that is not the intention, and non-cash compensation would qualify for that, but that's one of those stay tuned.
Right, because it's a difference between what does the application says one thing or implies one thing, and prior guidance says something else. But some of the things that the application has changed are very clear, and we're very comfortable that that's what it is now, that it is a change and it was intended to be a change. In this case, we don't know if it's just casual drafting or if it was intended to be a change. That's why we're hesitant on this issue.
Criteria for forgiveness. I think we've gone through pretty much that. So I think, yeah, will these funds be considered income, and will we pay taxes? So we brought this up last time, right after they issued, or I think we brought it up in a blast, I guess. But so the Treasury came out and applied Section 265, which means that it's a section that says you're not allowed a deduction for deductions that produce tax-exempt income. And the Treasury said, okay, that hey, the income on the forgiveness is it's not included in gross income, or it's not taxable. They said it's not taxable, but the deductions related to that are non-deductible. It has this exact impact of saying that the net impact is that it makes the loan forgiveness taxable, period. It's not double dipping. And if Congress put a section in saying this is not included in gross income, it didn't say this will be treated as non-taxable income, which would give credence to Section 265. They just said it's not included in gross income, and if they intended for it to be taxable, which is the net effect, then why would they wouldn't? If they didn't have that provision in there, we would have the exact same result as what Treasury is giving us right now in this notice. So we think that that's going to be, hopefully, we don't even, our personal opinion is Congress wouldn't even need to do a fix, because it's a clearly erroneous ruling, or it's not even a ruling, it's just a notice on its face. But Congress has been saying that they're going to provide a patch to that and clarify that Section 265 does not apply to this. And we don't even think it does apply in the first place, because it just says it excludes from gross income the loan proceeds, and doesn't say anything about being tax exempt. Is that right, Mark, on that?
I agree. We've got at least two ways of attacking it. One is the actual language, and the other is that it clearly is frustrating Congress's intent. And I think either one of those are winners. The problem with waiting for a technical correction is we just, in the CARES Act, we finally got a technical correction for something that was passed 3 years ago. So we don't hold a whole lot of hope out for when we get those.
Yeah, we're hoping they want to do a clean bill for the 12 to 16 week extension, and maybe they can push that in there, because it really it's frustrating Congress's intent, because maybe you don't want to bring your employees back. If you're not going to, you'll get a loan forgiveness, but it's just it'll have the effect of that loan forgiveness being taxable to you. So anyway, I have 2 or 3 project workers who get paid once a month. They get paid per billable hour. So sometimes the check can be large, like $8,000.
Yeah, what this question is getting at is the 15,385 limit, and that $100,000, or like we said, 15,385. That limit we really believe is for the entire 8-week period. So the fact that you pay different people on different schedules shouldn't matter. You're just going to do the calculations that are appropriate for that schedule. But in reality, we think you're only going to do the calculation once for the total period. Now, basically, if you've had a chance to look at the application that the link's been floating around, there is the 2-page application, then there's a schedule that's attached, and then there are worksheets that are attached to that. And those worksheets are basically a listing of employees, and in one column is cash compensation. And it looks like that the big test is going to be next to anybody's name, don't put a number bigger than 15,385. We think it's going to be that simple.
Okay, how does the CARES Act deal with sick time work during this 8-week period? My understanding is that sick time is a separate account in payroll processing. Sick time is included in the definition of cash compensation.
Well, maybe they're getting at the emergency sick time that was included in the FFCRA. If that's the case, that extra 10 days for COVID related, that you really now have two kinds of sick time. You have your regular sick time, and then you have this special 10 days of COVID sick time and the family leave that goes with it. Those new ideas you're going to get back as a payroll tax credit, so you're already getting that for free. So you don't get to include that in your cash compensation.
Yeah,
a regular
no
sick
double
time,
dipping, right? No double
right.
dipping.
Exactly. But the regular sick time that you pay, go ahead and put that in just like you would normally. So.
Yeah, I think that's what he was saying was he's getting a credit back for it. So that, yeah, you wouldn't be able to count that sick time pay twice.
Right.
ADP rep start.
Same idea that we're just making a distinction between.
Okay. ADP does not allow you to separate federal taxes out of payroll and withdraw that from a separate account. Okay, so there's two, I think. So I'm not a payroll tax person, but just federal taxes there's the employee's share that are withheld from their taxes. Those are not, you don't have to back those out. Maybe that's your question. Or,
I think it's that escrow, the idea of an escrow account. They're paying the payroll out of a separate account. It's not necessary. The money is money, right? It's fungible. I think that's the question. And, some banks are asking you to only pay forgivable expenses out of an account or make transfers that way. That all that is making the banks more interest. It's really not very cool, but you don't want to make the bank angry because they're the ones that are going to be looking at your forgiveness application. So you kind of got to do what the bank wants, but it really isn't necessary to try and keep, to worry about paying exactly forgivable costs out of an account. If you want to pay all of your payroll costs out of an account, and when it's gone, that's perfectly okay. If you've got people over 100, just pay them. Don't stress about it.
Okay. So they got the loan funded on May 8th, and their bi-weekly payroll ended on May 7th. So I guess then their new...
But it was paid on May 12th, so they got to count that.
Yep, okay, got it.
Yep. That's the idea. So even though you're paying you're paying payroll for a prior period, but you're actually paying it during the covered period, you are A-okay. This is how you're going to get this. This is almost perfect because you're going to get 10 weeks of payroll, not 8. That's that's a great result.
Congratulations.
Yep.
What we intend on doing is cutting payroll short at the end of the 8-week period and process and deposit before July 3rd. So remember again, if you're cutting it short, you're trying to match the cash outlay into your 8-week period. You don't need to do that. Okay. Right. You can pay it on your normal time, even though it's outside of the 8-week period, and then you get the number of days in the covered period included in your forgiveness calculation.
And here's another person who should be, they're going to get 9.5 weeks instead of 8, and that's right. That works.
Okay. FTE employees is 40 hours per week. That's the definition of what a full-time equivalent is. It's 40 hours per week. What happens if people take time off with or without PTO or sick time? Shouldn't we just pay our employees for 40 hours? So I guess, is this the voluntary question, Mark?
I don't know, but the way the FTE calculation is going to work is if somebody takes a sick day or a vacation day and you pay them for that 8 hours that week, then they're still considered to have worked 40, and there'll be 1 FTE. If, on the other hand, somebody took a day off that was not paid, then they only work 32 hours a week, then they would either be considered 0.8 of an FTE, 4/5, or in the simplified method, they'd be a 0.5 FTE. So if you pay them, however, for whatever reason, that counts as hours worked, and that also includes those special coronavirus related sick time and family leave time. But if you don't pay somebody for a day, that's excluded from the FTE calc. So that's all of the questions that were submitted in advance.
And I'm going over to the Q&A, and if they were on chat, we're not going to catch it. So if you had one that you wanted answered and you put it into chat.
We actually moved them over to the Q&A, so they're all in there for you.
Thank you, Jill. So the first, so if pay was reduced by more than 25%, but you met step 2, is that possible? And would that mean you're not subject to the loan reduction calculation? And I'll
pull up the form to see what they're.
Remember, if you restore their pay rate, remember the June 30th out too.
Yes. I believe what he's referring to is the process that is on the bottom of page 7 of the 11 pages. And when they're calculating the hourly or salary/hourly wage reduction, step 1 is saying, yes, it happened. But step 2 is the safe harbor. So if you meet the safe harbor, you're done. And as a matter of fact, if you meet the safe harbor, you don't even need to do step 1, which can be convoluted. So.
Okay, I added a family member to payroll after the PPP funds hit my account. Will a family member, spouse, who is not a prior employee be allowed forgiven? I'm going to have to say I'm not sure, because would that family member be considered through attribution an owner? and then you get into the owner rules, I would say, unless we get guidance saying no, that it would qualify. But I don't know. That I would just be careful.
Yeah, my worry is that I think we don't know what entity we're talking about, but I think they would be an owner by attribution, and since they had no income in 2019, I think that's your limit.
Yeah.
So there's no reason you can't do it, but I do not believe, and it's a permissible use of the loan funds. It's going to count towards the 75% overall. It's just not going to be forgivable.
Apparently, yeah. We don't have.
Yeah, we don't have guidance.
We don't have an attribution standard in the rules anywhere, but it would seem that would be the result. Okay. Is the payment term for paying back the PPP loan that is not forgiven fixed, or can you request an extension? I believe it's fixed, where your extension would be, because you have a deferment for 6 months. Maybe there can be a deferment of that. I'm not positive.
Right. Payments are deferred until the 7th month of the loan. And, so there's a 6-month deferral of payments, because if you think about it, you get a loan today, your first payment isn't due for a month. So the first payment would be due, 7 months after loan funding. And it's possible that you could defer that 6 more months. So especially if you haven't done the loan forgiveness app, it would be very weird for the bank to start collecting payments that they're going to have to turn around and refund to you. So if your loan forgiveness application is outstanding, that might be all they need as an excuse to extend you from 6 to 12 months on the payment deferral.
Okay, so the next question is, what do we do with, we have defined benefit plan contributions and employer 401k payments. Line 1 payroll cost appears to be limited to 100,000, and I think line 1 is
only cash compensation.
Cash compensation again. So remember, there's not the non-cash compensation, which what those expenses are not limited, except for owner. What the definitions say: owner, employees, partners, or sole proprietors. You cannot include the non-cash payroll costs in it. Again, S corporation owner employees and C corporation owner employees, we're thinking you can, and it's not capped at 100,000.
And so the answer about where do you put the defined benefit and 401k payments, they go on Schedule A, line 7, and line 1 is cash compensation, and line 4 is cash compensation. From the 2 different tables about whether you're over 100,000 or not. And
so the next one is, do you need to use 75% of the funds for payroll to qualify for any forgiveness? That was my comment about the confusion about the cliff test, and the answer is no. There's no cliff test. So it's just going to be the way if you have payroll costs again of 75,000, and then your maximum loan forgiveness would be 100,000, your non-payroll cost would be 25, because you divide the payroll cost by 0.75. Would discretionary bonuses be included? We've already gone through that. Yes. Sole proprietor, B of A stated that they can't base a loan or forgiveness on any payments they made to independent contractors, only on what the bottom line net income is. Unfortunately, that's the case. The way the form reads, though, remember, is it looks like you can include in the loan forgiveness amount non-payroll costs, limited to 25% of the total. So that's a big break. Is that okay, Mark?
I don't, I missed something. I'm not sure how that applies to the independent contractor question.
Oh, it doesn't.
Okay. Okay. I guess you skipped to another question.
No. It's just that does it apply to payments they made to independent contractors? The answer is no. It's just based on the bottom line net income. I'm confirming that.
Yeah.
I'm just saying that, but now if you had rent and utilities, then you could possibly add that to that amount.
Okay, I see your point. What Dave and I are batting around here is that when way back on April probably 8th or 9th, when they issued the original instructions, back on April 2nd. I know it seems a whole lot longer ago than that, but that's when we started this game. And then they issued instructions for Schedule C, sole proprietors on April, like I said, about 8 or 9. Those instructions then seem to say that the amount forgiven for a sole proprietor that didn't have any employees would only be based on 8/52 of their net from the prior year. And that seemed rather harsh, and we didn't like it, and we kind of screamed about it. But now when you look at the way the Schedule A and the form is working here, a sole proprietor who has no employees is going to get rents, utilities, and interest. So yes, that's a good thing. That's one of the many things in these instructions that are pro borrower.
On the other hand, payments to independent contractors do not qualify as payments for or as payroll costs. I guess that's kind of the bottom line. But I just wanted to highlight the rent and utilities and all that again.
And they never did. And the reason they never did is because an independent contractor can go out and get their own loan.
Yep. Okay, loan disbursement date is April 29th. And they haven't paid April rent because they're waiting to get the loan and struggling. And now they pay the rent, April rent on April 30th. Is that includable? And the answer is yes, because it's paid within the covered period. Are taxes, state, federal, et cetera, included in your payroll totals for forgiveness? I know federal was excluded in the application calculations, but wondering about, it's the same in the forgiveness. Federal employer share of payroll taxes are excluded in the forgiveness. State share, which is generally state unemployment and the ETT, are includable.
And again, the reason for that is you have a separate opportunity to defer the payment of those FICA taxes, through the end of next year and beyond. So
does previous months, so you have sales commissions to salesmen in months or in periods prior to, I guess, the forgiveness period, and then are you paying those in the forgiveness period? Do those qualify? If you're W-2ing and paying those in the forgiveness period, I think they would qualify.
I think so too. But if you pay them in March, you're out of luck.
Yeah. So you have to pay it in the forgiveness period. If the forgiving period is going to be, forgiveness period is going to be extended, why should we do the application now? Why not wait? And that's kind of our point is, in other words, you're going to have to wait anyway until July to do your forgiveness because you want to get past the June 30th date for the safe harbors. You're going to want to get your payroll tax returns completed. But then maybe there's no rush, especially if you're getting some big deferrals on your employer payroll taxes, and if there's going to be an extension of the week period, that's just going to boost up your forgiveness amount. So you might not pay to rush. Do the partners in a partnership have to actually make their income distribution during the 8-week period in order for it to be considered part of the forgivable account? That's the nuance that, and the answer we think it's yes, the way the instructions are. Unfortunately, we thought before you would just take 8/52 of their 2019 income, but in this case, it is you need to make a partner draw out to the partners during that period, at least equal to the amount that you're getting forgiveness on. Can you contribute it right back? Probably, but we just think you need to make that payment. Okay, if we do not meet the 75% of the 2019 payroll calc, how does it go to the 1% loan? So just any amount that if your loan forgiveness amount is lower than your loan, it's going to be carried over and continue to accrue 1%. You're going to start payments after the 6-month deferral period and pay that through the next 18 months. Okay, so forgiveness equals taxable income. I think we kind of hammered on that. And the effect of the notice again is it is taxable because of the way the IRS is treating it. But we think that will change. Does the rent utilities forgiveness for sole proprietors apply to home office? And we just went over that. I think it would. If you have a home office, you're incurring those expenses, and you show you have utility bills for your home office and so forth. I think that would work. Can some of PPP be used for office expense and supplies, and i.e. computers? It has to fit into the utilities area, and I think you would be hard pressed to stretch. Remember I said there's some elasticity. I think office expense and supplies and computers would be a little bit stretching. Now, if you're putting in modems or you're putting in things that increase the connectivity of the computers or make it for remote, maybe you can stretch that into the internet, but then you would have to have I don't know, it would probably be a strong stretch there. All right, as a Schedule C with no employees, do I physically have to write checks to me? We answered that already, and I would say yes, just to be safe. You're gonna have to provide a canceled check on the amount paid, I believe on that. If the period exceeds 8 weeks, are we able to request additional funding? And so right now the answer is no. But we'll have to wait and see if Congress comes out with additional funding round 2. That's what we're saying. It might happen, but right now, no. If your loan is funded in the middle of your payroll period, do you have to prorate your payroll to match with the loan period? And again, remember it's a paid in or incurred theory again. Go ahead, Mark. You were going to comment.
I'm sorry. I am still just gobsmacked that they gave us the best possible interpretation, and so yes, you get the best of both worlds. So no, you don't have to do it on the front end, and you get to do it on the back end. So
there you go.
It's just basically they extended the 8-week period. Without saying it's larger than 8 weeks, but they did. I think there was this initial push that the whole loan shouldn't be forgivable, and now it looks like they're trying to make it forgivable. So that's all good.
I have a small business, and as the owner and the only salaried employee, can I pay myself a bonus and have it apply to the 8-week period? Answer is yes, but remember, the amount that goes to forgiveness is the lesser of your 2019 earnings divided by 52 times 8. So if you didn't pay yourself a big bonus in 2019, then you might be limited. And then you have the other side of it is the cap of 15,385. So you can pay your huge bonus, but you're never going to get more than 15,385.
But the point is that is payroll, and so as long as you don't exceed last year, it is a permissible use of the funds.
Yeah. So that would qualify, but not for forgiveness, but it would be permissible. What comprises rent? All such leases. Yep. I have a small business. Oh, I'm sorry, but we just had that one. 1099 employees. No, that is oxymoron, right?
Yeah,
you don't have 1099 employees. They're either a 1099 independent contractor or an employee. If you're issuing 1099, they're not an employee, and therefore they do not qualify. That's the next two. Next one is worker comp premium payroll costs, and it seems like it should be, but it's specifically not included, so the answer would be no. You mentioned that sole proprietor companies can include utilities. Does this also apply to C corporations? And C corporations are definitely, there was never any issue on C corporations on this issue. Where, like Mark said, where we had an issue was on sole proprietors. We were told you're not going to be able to include those things, and now the instructions imply that you can, just for sole proprietors. Loans. Okay, go ahead. Go ahead, Mark.
The next one is that the loan was dispersed on 5/15, and pay date was 5/15, even though they'd made the transfer before. Well, you won the lottery. You got the best possible world. Funding on pay date is the best way to go.
Yeah, and the instructions specifically say that payment that would be included is not when you fund your imprest account. It's when the ACH or checks are actually written to your employees.
Yep.
All right. If payroll is made on 4/20 for 4/1 through 4/16, loan date of 4/29, no, it won't. The previous payroll won't apply because it's not paid or incurred in the period. Does the cash compensation 100,000 annualized max include employer paid health care? Nope. Remember, the non-cash payroll are not subject to 100,000 limit. Which 8-week period in 2019 are we supposed to use? There's no such 8-week period in 2019, as far as I know. So.
Right. For the FTE test, the two look back periods are February 15th through June 30th of 19, or January 1st through February 29th of 2020. So, yeah, and the other The other look back test that would be in 2019 would be if you were doing a seasonal calculation, you would be comparing that to a 12-week period in 2019, not an 8-week.
I am the owner. I started my business in early 2019, not taking a salary or draw. Can I use the 2020 period to set my max limit I take out during the covered period? I think the way it's written is that you can't. You have to base it on your 2019
right.
competition.
If they were a partner in a partnership, then whatever the 2019 net was, they could use that to base their forgivable amount in 2020. But if they're an S corp, and they didn't pay a payroll, then there's nothing there to use. So if you were a partner or a C corp and you had profits, then you get to use those profits, but otherwise no.
Okay, this is a very common situation, what we hear. We reduced our payroll and reduced hours early on, not knowing if we would receive a PPP. And there was a lot of confusion and we didn't know, but so owners took a 50% cut. Management has been on 50% hourly with variable hour adjustment. We have been funded. We will continue with this through June. We were funded May 13th, started the payroll adjust last week of March. My question is, assuming we're paying at 60% of normal payroll during this time of forgiveness, will we be forgiven for what we paid in payroll? And the answer is yes, but you're going to have to do the FTE and payroll or wage rate reduction haircuts, I believe.
And based on the little information we have, the dollar for dollar, if you're at 60% of your payroll, that's obviously less than 75. So that 15% is going to be a dollar for dollar reduction. So that dollar for dollar reduction is going to take you from 60% down to 45%. And then you've got an FTE calculation. You're only at 60%, presumably. And so you multiply that 60% times the times the 45%, you're at 20 some percent forgiveness. So when those two limitations work together, they become very draconian. They're very punitive. And so in this situation, I hope your business turns around so that on June 30th, you can restore everybody. And then at least you'll get the full 60% of the loan forgiven instead of getting only 20% of the loan forgiven.
Can you clarify how does the reduction in wages work? The pay rate, and I guess that's the pay rate reduction. Should we compare wages for a list of employees that work during the 8 weeks after the funding to the wages? No. So this is one where it's like 13 steps to do, but it's all based on it's based on the 8-week covered period, not anything after the covered period.
And the two look back periods again are 1/1 through February 29th of 2020, or 2/15/19 through 6/30/19. So yes, you're going to have to do that math.
Okay, our industry is such that we are just now seeing the effects in May. The loss of business. So there's a lag, and there's going to be other industries that are going to be in a similar lag in the next few months. But we will opt to maintain a reduction in our payroll, if we're allowed 12 to 16 weeks in the calc, does this help to add up the accumulation of the 75% of payroll? And the answer is definitely yes. And that is the whole reason, intention of why there's a push by the industry leaders, by Congress, and by some in the administration to do the extension, because they're finding the headwinds, especially, you know, people are making more on unemployment than they are in, you know, that you could pay them. There's no incentive to come back, and people are having a hard time bringing people back. So it is, yeah. All right, for a sole proprietor, B of A, okay, so we got that one, I think. I own an S Corp, I'm an owner employee, I'm limited to the forgiveness from 2019 numbers from my payroll. Am I to assume that I cannot pay myself a code? Yep, I would think that's right. That's what the rules say. You can't, you're limited to the lesser of the two. It's one of the few items in the instructions that's new, and that's negative. Okay. How do you treat salary employees in the FTE calculation? You have to, yeah, you have to track the hours worked, and the answer is yes. You know, just think though that if they're salaried, then you know, what are they contracted? What are you paying them salary for? If it's 40 hours plus, then they're a 1. It's easy. Anything, they can work 80 hours a week and they're 1. They can work 60. You know, but if they're contracted to work 30 hours a week, then you're going to have a points of, what is it, 0.8 or 0.7, whatever, bad example, but of FTE. That sound right, Mark?
It does, and you know, for the reason for the math there is the IRS, or pardon me, the SBA wants all of these FTE calculations with one, you know, with a point, with no more than 1 digit to the right of the decimal point. So you can't have a 0.75 for 30 hours. That's probably going to be a 0.8, but we don't know.
Okay, I keep seeing everything based on weekly payrolls. How do I convert my semi-monthly payrolls to meet? So
No need.
No need, yeah. And on the application, one of the very first things you fill out on the top, it's what's my pay period? You know, what is it? Am I bi-weekly, semi-monthly, monthly, weekly? All right, employees which work 16 to 30 hours, how would they get calculated?
Well, if you have you know, if you're going to divide 16 by 40 and divide 30 by 40, and depending on which you have more of, you're either going to use the regular method or you're going to treat them all as a half. So that's why you have to do it both ways to just figure out which comes out best.
Yep. Okay, please clarify the incurred and paid. Is it paid and incurred, or paid or incurred? The rules are paid and incurred, but the definition of that is the inclusive paid and incurred, not the exclusive paid and incurred. So as we said, you get the best of both worlds.
Yeah, when Congress wrote the law, they were essentially making a list, and so and was used, not meaning you have to meet both requirements, and was used to say you get A, and you get B, and you get C. Yeah, so.
All of my employees are part-time. Their hours were reduced. However, they are still working. How should we calculate for the safe harbor? Well, the safe harbor would be bringing them back in to the same number of hours by June 30th. But otherwise, you would have to do an FTE before and after, and maybe in that case you could use a 0.5 for both and not have a reduction. Is that possible, Mark? Is that so? If they're part-time before and they're part-time after,
Yes, that's possible.
so they're working 30 hours before, now they're working 20 hours, you could use 0.5 simplified, and then you're going to have 0.5 before and 0.5 after and not have an FTE reduction.
And you might even be able, in that case, to just check the box. I mean, because there was no FTE reduction at all. So you might.
Yeah, and not go through all those calculations.
Yeah.
If there are no changes in the number of employees or their wages, can you still qualify for forgiveness of payroll for the said periods? Yeah.
Of course.
That's the definition. That's gold. That's if you're not changing anybody and you're keeping going. I guess that maybe is kind of underlying tone is going back to, did I really need this loan? Because when I certified, I thought business was going to turn down. I might have to lay off all my employees. I need this loan. I certified. And now you come around and your business, maybe you're one of the businesses that's going to get impacted on as a lag industry, and you're going full bore ahead on your employees. Can you still get loan forgiveness? Absolutely. You're qualifying based on this 8-week covered period, and you're paying your employees. You're not having any FTE wage rate reductions, and if your loan was under $2 million, you don't have to worry about, when you certified that you needed it, you meant it. And even if it's above 2 million, if you had serious doubts and even though it turned out it didn't matter, you should be okay. So I think that might be the underlying tone of that question, but it's a good question.
The next one is can you take the accrual for rent, or is it only the cash paid? Unfortunately, it's only the cash paid, with that small exception that if you incur it during the period, you can pay it at the next billing date. And can wages be prepaid? We talked about this a little bit. Yes, but you're certainly at risk, and you have the same 15,385 limit. What about parking? It's paid separately, but we pay it for all employees. The question there is, are your employees being taxed on the parking? In which case it's cash compensation. If they're not, it's not cash compensation. So that strictly depends on how you're handling it. What is
transportation under utilities? That's a great question, and I have no solid answer. It's one of those things that was in the act. It was in the interim rules, and so far there's been no specific guidance. I would assume it's at least gas and maybe Uber. I don't know, cabs or transportation. Who knows right now? It's a tough one. We were only able to get a PPP loan for 75% of the amount of 8 weeks wages. While thankful to get any dollars at all, is there anything we can do to cover this shortfall? So I think I'm struggling with that.
As far as a PPP loan goes, no, because you can only get a single PPP loan. What you could do is you could apply for an idle loan for payroll after the 8 weeks. But the problem with the idle loans is, even though Congress intended them to go up to 2 million, the SBA seems to be limiting them to very small amounts, anywhere in the neighborhood of $10,000 to $30,000. So that's a problem. Other sources of loan funding other than traditional financing would be the Main Street loan program directly from the Federal Reserve, and that's coming hopefully very shortly. They've released several documents, but they're still in sort of comment stages and aren't really taking apps yet, as far as I know. But that's supposed to be coming very soon.
Will we be able to count overtime in the payroll total? Yes. What is the penalty of having less FTE than we put on the original application?
Probably nothing.
Yeah.
I mean, there are several things that are sort of informational, that they're trying to do their reporting and whatnot, and they've changed their mind 3 times on how you do your head count, and so the original number of employees was literally a head count, whether somebody worked 1 hour for you in the past versus full-time or more than full-time. So I don't think there's any result. I mean, the real FTE calculations are going to be done now on this forgiveness app, and that's what's going to get looked at.
About expenses directly as a result of COVID-19, it's not how it relates to COVID-19. It's if it fits in payroll costs and the non-payroll cost defined categories. After the 8-week period, how long do you have to file the loan forgiveness application? We kind of went through that, and it probably you won't be able to till the middle of July, but you might not want to right away because of the possible extension of the 8 weeks, and also for the deferral of the employer portion of the FICA tax. And if you get the interest forgiven on the forgiven portion, then there's really, and you can expand the forgiven portion, then it's a win-win to wait. So we're not saying don't do it early, but you need to don't rush for it. It's not something you need to be like the Oklahoma land rush that we did on the application side. You need to have a lot of thought into it, and
right.
consult with us, talk to us about it, and we can kind of help you with that.
What you need to do is pay your employees. That's what you need to be doing right now to maximize your forgiveness. That advice hasn't changed. Let's see, if renewed an office lease, you renewed it on 3/3, but the lease was in effect in 2020. That should not be a problem at all, because
I think it was for the same property, and and you had to lease it in effect on that property as of 2/15. That would be good.
So where do temp staffing costs go in the calculation? Unfortunately, temps don't count as payroll costs. They're not your employee. On the other hand, if you have some sort of PEO or SEO where they really are treated as your employee, or you're a joint employer, then those things you get. ADP does a lot of those arrangements. When we file payroll, do we do anything special at this time? Nope.
Pay away.
Yeah, an S Corp. As an S Corp, the bulk of income of the 2 owners is in distributions. Can those count for forgiveness? Unfortunately, no. For an S corp, it's only the salary that was paid, and this, you know, in general, with an S corp, with a highly profitable S corp, you want to be paying a salary that's close to the FICA limit anyway to stay out of trouble. So, you know, oh well, yeah. If you're paying a low number now, there's not much we can do about it. What's included in transportation costs?
Talked about that already.
Right.
We're not sure.
Can you pay rent early? Yes, we believe you can prepay.
But still, we're kind of waiting and seeing on that a little bit to see, you know. Applied for an SBA loan on 5/2 and received, so SBA, I'm assuming that's a PPP loan, and received approval of up to 100. Oh, that's just a regular SBA loan. Okay, and asked to fill out the form online, amount approved, 30-year loan, 3.75. Seems this approval is for a different type of loan. Yeah, the SBA loan, traditional loan, is not forgivable. You're going to be paying the interest, and
we really, really, really hope that the purpose of that loan does not include payroll in May and June. Because if it does, then you may have a big problem with your PPP loan, and you might want to go back and try and get the loan purpose revised, because otherwise the PPP loan is not forgivable at all. Do several
the SBA loan, oh yeah, PPP loan if you have one for the same purpose, yeah.
Right.
So we'll contact you and see if we can help you on that.
Do severance payments count as long as they're paid during the 8-week period? Absolutely.
Okay, what will happen to FTE calculation if employee goes out on maternity leave in the middle of the 8-week period? Do we have to keep them in the FTE calculation?
I'm going to go out on a limb here. Okay, understand this is very aggressive. Most women are not going to agree with me, but I'm going to say that and factually it may be not. She may have no choice but to go out early. But I think that we're going to treat this as a voluntary reduction in hours. It's something that she requested and you've granted, or you obviously have to grant it, but in any case, I think this fits in the flavor of the exception that FAQ 40 that we were talking about, that this is a reduction in your FTE that is not in your control. You know, this is outside your control, and so I don't think this is going to count against you. If you replace the person, great. My advice is that if you replace the person for this time period, that you make it a slightly different job title so that it's not a replacement, and you get to add it into the calculation. So these are the kinds of things that we are so excited about, because the rules we were looking at 3 weeks ago were very anti-borrower, very anti-business, and you can see that things like this now fit in to some very pro-business rules.
I'm not sure how to answer the next one. Who really is deferring FICA if they have a payroll processing firm? I'm not.
By this Paychex and ADP and other processors, they were supposed to start this on payrolls on or after April 27th. And most of them just said, whoa, sorry, we can't do this until second quarter. But as far as I know, everybody should be doing this. If you request them not to make those deposits, they should not be making the deposits for the FICA. Obviously, the employee FICA, they've got to make the deposit on, but the employer FICA, they shouldn't be making the deposits.
I think you're retaining it. The employer is retaining.
Yes.
You're not depositing that with ADP. You're holding on to the funds. It's not the payroll company doesn't get to hold on to it. And
right, but ADP on the calculation they do about how much you need to fund, a few days ahead of payroll, this number should be at your option excluded. I'm sure you have to call them up and tell them to do it, but they should do it.
Number of employees dropped before 215 for regular business reasons. Will that count against us due to FTE reduction limitations? Or would that not apply in this case?
Actually, it helps you because one of the look back periods is 1/1 through February 29th of this year. So if you had reductions before February 29th, it's to your benefit.
Yep. We have
easier to hit the safe harbor.
Yep. We have 2 hourly employees whose hours were reduced. Each was less than 25% of total hours. Their hourly rate has not been reduced. Is this okay for the FTE safe harbor?
No, it's not.
It's okay for the wage rate reduction because you didn't reduce their rate, but it's going to hurt you on the headcount reduction.
Yeah. Yes.
And another question about the FICA deferral and getting your payroll company to get that to happen. I'm not sure. You're going to have to contact them and say we don't want to remit this amount. We want to defer it.
Same question.
Same question. Same question. Oh, something to request deferral.
Yeah, I don't think that there is any requirement. I'm not aware of any bank putting a covenant in that says you'll do your forgiveness at this time. There might be. Will the June 30th day change to later if we go to 12 weeks or 16 weeks? It might or it might not, depending on what they're trying to accomplish. And since we haven't even seen a draft bill, we don't know.
Clarify the safe harbor rule in lieu of the FTE calculation. So we have biweekly payroll. So first question is, you don't even have to go into the FTE calculation rule if you can satisfy the safe harbor rule.
And the safe harbor rule, just to repeat, is that if you had a reduction in FTEs during the period 215 to 426, so as COVID was first breaking out, if you had any sort of furloughs or layoffs or just reduced work schedules then and it doesn't relate to the covered period. It's related to the start of this crisis. If you had a reduction, and that's step one, and step two is you restored everybody back to normal hours on June 30th, then you meet the safe harbor.
I think there was a second question on that, but I can't see it now. Anyway, all right. We have substantial monthly charges for our electronic med record company and our IT consultant. Any thought that these could be utility costs? Internet, maybe internet security because it's internet.
I'm very hesitant on this. I think that when we finally get the rules, it's going to be the dumb pipe idea that it's only your internet access and not much else. I mean, right now, without that guidance, as Dave said earlier, you might be able to put in all sorts of internet costs, but I don't think you can put in your email or your Zoom costs, but then again, is Zoom just a video telephone? I maybe, you know,
I would lean more towards it. You could stretch it, but
yeah.
That would be the aggressive thing. But yeah, I think that the IT consultant and 1099 stuff is definitely not, unless you can fit it into the non-payroll costs category somehow.
The next one, they received an idle advance, and unfortunately, yes, that will reduce your PPPL forgiveness.
Yep. Do we know at this point if the PPP related expenses will be deducted on the 2020 tax return? And we've kind of hammered that. It's right now, according to Treasury, no. What comprises rent? All leases, equipment, personal property, and real. On FTE, we have not cut anyone, but a couple are out on leave of absence. Does that work? And again, Mark, that's voluntary, and
That's what I would go with.
they would not count towards the FTE. They would, you know, in the safe harbor, and I think it would have no problem there. Obviously, you're not paying them payroll, so your total forgiveness amount again is going to be lower because you're not paying somebody payroll. It's just you won't have the reductions. Did you say we can prepay rent through the end of the year if the 25% of our loan amount can cover the cost? And we said that it appears that way, but I would just be cautious still. And we'll see if they come out in the rules with any restrictions on that. Does any paid vacation to an employee who's currently on EDD? I guess EDD means unemployment, qualify, or is that?
Yeah, the answer here is if somebody's getting unemployment, you shouldn't be paying them a dime unless you actively, you know, unless you did a final termination and you're just paying out all of their accrued benefits. If that's the case, then yes, it does count, because it's just like paying vacation to anybody else.
What's the process for delaying forgiveness filing? Well, you can slow walk it, you know.
We don't have a deadline to file yet.
Yeah. What if you just received your funding? Is the 8-week period that we are working with on or through June 30th? No, I mean, 8-week period does not end at June 30th, as far as we can tell. I mean, there's nothing in the instructions that would cut that short, so you'd have a shorter than 8-week period.
Based on this, the instructions to this application, it looks like you can get your loan on June 30th and then have 8 weeks, because that's technically when the loan funding is supposed to end.
I don't know how you're going to do the safe harbors and all the FTE calculations on that.
It'd be a real joy.
It spans June 30th, so another fun thing to consider. Business has 21 employees, 5 have decided not to return. Should we have, and is that, my question would be, is that a voluntary thing? You've asked them to, and they say, no, I'm not going to come back. You've made a valid offer for them to come back. If you have, keep the valid offers to show that you attempted. That's not going to, they won't count against you in the head count reduction. Should we have an issue qualifying for forgiveness with the, we do not have enough hours available to hire replacements. I think, go ahead, Mark.
So what will happen is your payroll costs will be lower, and so the amount that you can get forgiven will be lower. but you won't be hit with any of the limitations and penalties.
Yeah. It looks like you cannot include severance pay during the covered period. I think you can, as long as it's paid in the covered period and it doesn't go beyond the $15,385. I don't think there's a prohibition against that.
Yeah, I don't either.
If you only meet 60% of payroll costs for the loan total, are you only given 60% forgiveness, or do you get no forgiveness? That's again the cliff testing again, and it's the 60%. So 60% of payroll cost. Yeah, you can only get. So let's say it was you're asking for a loan forgiveness of 100, and it's 60,000, and you divide that by 0.75. Then the amount of non-payroll costs would be limited to that total amount. That gets you that 0.75. All right, Schedule A worksheet, Table 1 and Table 2. Somebody's actually gone in and with the tables here. Relative to 100,000 annualized rate for any period in 2019. And my commission employees receive small draws on the first and large commissions on the 15th. So commission can be larger than 4,166, but they will only earn 75. And that right now, the way it looks, it's for any pay period. So if you have somebody that goes through the 100,000 annualization for that pay period, for any pay period, then I think they will go to Table 2, and which is not a bad thing, because they're not going to be part of your FTE or payroll reduction calculation, or just the FTE calculation. Right, Mark?
Yep.
Okay. I received idle money.
Answered.
Yep. Answered. Idle. Okay. Can you please expand on owner employees' lack of ability to have non-payroll costs forgiven? Again, the way the instructions are written, it implies that an owner employee can does not qualify for non-payroll costs forgiven, but based on we think that a C Corp owner employee would still qualify, and an S Corp would still qualify for the non-payroll, or it's not even non-payroll costs forgiven, it's non-cash payroll costs. Yeah. You can still qualify for the non-payroll costs, which are rent, utilities, mortgage interest. My health care insurance premiums and other non-cash payroll costs will not be forgiven. And the answer is possibly yes. Those relating to the owner employee, we're going to have to get, I think that's one thing we're going to have to just wait and see. Are we required to maintain a separate account for a loan amount, or is it up to us? The answer is number one, there's nothing in the rules and regulations requiring to maintain a separate account. Is it up to you? It's probably more up to your bank who's making you do it or not. How do we calculate equipment lease payments for loan forgiveness? Can we use the full amount or only the interest? So I think this is a question relating to maybe a capital lease. So if it's a purchase lease or capital lease, then that's not a lease payment that would qualify. It'd only be a true operating lease payment on equipment.
Right, but if it is a capital lease, you do get the interest.
You do get the interest because you have a secured interest. Yeah, only interest. We terminate an employee for cause. Can we bonus existing employees to maximize forgiveness? And so first aspect of it, I think a termination for cause is an exception to the FTE. So,
Yep, that's the fact for you. Yeah.
for that purpose, you're home free. But for the purpose of just getting your payroll cost up, you definitely can pay extra to the people that are left, especially if they're picking up the mess on the terminated employee. And but remember, you're capped at $15,385. Okay.
Is there a requirement to apply for forgiveness within 60 days? Only if the bank you got your loan from is a royal pain. There should not be, there's nothing in any of the Treasury, SBA rules or publications, and it certainly doesn't exist in the CARES Act.
And it might be their misinterpretation or your misinterpretation, because the 60-day rule is that the bank has 60 days from the time that you submit your application for forgiveness to approve that and give you the forgiveness. So the 60-day is not before, it's not from the end of the covered period to when you apply, it's from when you apply to when they have to offer your forgiveness. So the earliest you're going to probably expect it, and we mentioned this in our last webinar, I believe, is if you apply July 15th, if you go early, that's probably the earliest, and the bank's probably going to take the full 60 days. So you're looking at, because it's just such a huge undertaking, it's probably a September forgiveness time period. All right.
Let me take this next one.
Sure.
If an employee refuses to come back to work, I believe you stated you were assuming we can still count in FTE and possibly count wages they've made. Absolutely not. Let's try and make this clear. If they refuse to come back to work, they don't count against you in the FTE calculations. You don't get to count them. They just evaporate out of that calculation. The wages that you didn't pay them are missing from your payroll costs in the covered period. So this relates to the question Dave was just answering, that maybe you want to pay those wages to somebody else. Yeah. But yes, the missing wages would reduce forgiveness, because you start your forgiveness calc with what did you pay during those 8 weeks.
Okay, we pay every 2 weeks and we're funded halfway into our 2-week period. Can we choose the following biweekly period as the start of our 8 weeks? And the answer is, if your payroll period is biweekly or less frequent, you can choose to start it at the beginning of that biweekly period. I think Mark made a great point earlier that you might not want to, because you might be able to, that might get you to an 8-week payroll number, might be easier to account for, but then you might be leaving a week or 2 on the table. Rent includes payments for real and personal property. Are auto lease payments forgiven? And if it's used in the business, definitely auto is a personal property. Yep. What about, I'm sorry.
Yeah, we have the parking question again. It depends on who's being taxed on it.
So question about stipend. The week we shut down, it was prior to the funding. Can we include that? The answer is no. It has to be paid or incurred during the covered 8-week period. Is loan interest or principal forgiven? So, and our opinion is that, and it's based on every single interim rule has repeated this, that the Treasury SBA has issued, that the interest on the portion of the loan that is forgiven will be forgiven. Okay, so it's our opinion that interest should be forgiven, but it's still kind of up in the air.
We could also read the question that they were talking about other loans. If they're talking about other loans, it's only interest. So.
Okay. We were considering the bonuses to maximize forgiveness amount. The potential 8-week extension made us rethink. We were funded on 414. Will we even know by the end of our covered period? And I think,
crystal ball.
Yeah.
We don't know how fast the House and Senate will move on this idea, or even if they'll move on it.
Yeah. Can we pay 10 weeks of payroll during the 8 weeks? And the answer is we've gone through a couple examples that that's possible. Can an owner that was not paid in 2019 get paid during the 8-week period? Yeah, you can pay, but it's not going to qualify for loan forgiveness. Will loan forgiveness amount be taxable? And right now, the way Treasury's ruling is yes, it will be taxable, but it's still, so why do it? Because it's a forgiveness. You're getting a benefit, a dollar benefit, and you have to pay tax on that dollar. So you're still getting a benefit. Is it possible to send the handout on the safe harbor information and how you would qualify? I think so. When we could do something like that, we'll look into it.
Yeah, right now, that information on the 11 page, on the 11 page link that you were given in the chat, it is the safe harbor for the hourly wage reduction or salary hourly wage reduction is described in step 2 on the bottom of page 7. And the safe harbor for the FTE reduction is described on the bottom of page 8. You know, so that until we get you a blast, hopefully that helps.
We give profit sharing contributions to all employees. Does the 15,385 cap rule apply for employees who earn more than 100,000? And the answer is no, it does not, because if it's to a qualified prop plan, I mean, if you're doing profit sharing not to a qualified plan, you're just giving bonuses, then that would be subject to the cap. But the profit sharing contribution to a qualified plan is considered non-cash compensation and is not subject to the 15,385 per employee.
Excuse me, Dave and Mark, we're already past 1 o'clock, and I know you've still got dozens more to answer.
Yeah.
So we still have quite a few people on, but we are at the 3-hour mark. So it's up to you guys. What would you like to do?
Probably we can wrap it up. And then what we'll try to do is there a possible way that we can answer some of these offline, or I'm not sure.
I think that's a great idea, or you guys could even record a quick video to finish through the rest of them.
Okay, sounds good.
And apologies, everyone. We just had an overwhelming amount of questions, and I know that Dave and Mark have been going at it strong for 3 hours now, and a lot of you have held out as well, and we've tried to answer as many questions as possible. So do you guys want to answer a couple more and then wrap it up?
Yeah, I guess so.
Take the next 2 and...
All right. If our payroll and extra exceeds our loan, are we able to get full loan forgiveness? So if your amount that you paid that's under the 15,385 per employee during the covered period is more than your loan, you're going to get full forgiveness. Yes. A good way of getting full forgiveness. 8-week period ends 6/15. Can I include a telephone bill that we pay $620 for the prior month's calls that fell in the covered period. I would say yes, that's the classic definition of the incurred and then paid on the very next bill. Sublease income, is it subtracted from our rent payment to the landlord?
We have no guidance on that.
That's a great question.
It really is, and it raises all sorts of theoretical ideas. Let's hope that that's not what it takes to get full forgiveness, but I would certainly apply for it, because there's no rule that says you can't take the full amount. So let's start with that and see how it works. You know, if it's not necessary, take the net. You know, wait.
All right, I think that's, I'm kind of scrolling through, and I think that should do it. I think yeah. So just in summary, hope this kind of answers your questions. Our main goal again was to give you information that you can take action right now to maximize your loan forgiveness and get out from underneath these reduction calculations, give you the knowledge and power to act now. What we didn't do, and it goes to the issue on, can we get more information on the safe harbor calculation, which those calculations are incredibly detailed. Getting the information together on this application to submit is going to be incredibly detailed. We couldn't do that today, but and I still think you're going to need our assistance when the time comes to file that. But in the meantime, you need to have, we hope this gives you the knowledge that you need to take the actions to maximize your loan forgiveness, and to plan, you know, the timing of when you plan for the you apply, and those types of things. So and then if you have questions, we're glad to field those, help you out, and then when it comes time to actually filing, we're here to help you on that too. So anything else in closing, Mark?
Just I want to hit again that if you do fall subject to the limitations, they become pretty draconian, you know, very quickly. And I think we had a limit where somebody their payroll was 60% of what it was before, and yet their loan forgiveness was only going to be 20% of the loan. So it really does make sense to try and to either not have the reductions, if that's at all possible, or to be sure and meet the safe harbors, because otherwise the loan forgiveness amount is going to be much less than what you were hoping for. So.
I hope this has been helpful. So, and then we'll try to answer these other questions. We'll see if there's a way we can get a list of it and send that out to the attendees that asked the questions. So
absolutely, we have record of who asked what, and again, many of the questions that are left have been answered in some way, shape, or form already, but we will get back to those of you that have specific ones. We'll do our best to answer them all. I want to thank all of you again for sticking with us for 3 hours plus, and I want to thank you for your time. And this is not the last of our webinars. There's more to come, so continue to check your inbox for more relevant alerts and emails and webinar invitations, and we'll see all of you soon. Take care now. Bye-bye.